For decades, one number has defined how we understand the American economy: GDP, gross domestic product, the total value of everything a nation produces. When GDP is strong, confidence soars. When it weakens, fear spreads. But in 2026, the story behind America's GDP is more complex than ever before. This isn't a boom economy. And it's not a collapsing economy. It is a changing economy. On the surface, the data shows moderate growth, not explosive, not alarming. But if you look beneath those top-line numbers, something much deeper is happening. The very structure of the American economy is shifting. To understand what the data really means, we have to go beyond the charts and graphs. We have to look at how Americans actually live, work, and spend, because GDP at its heart is a mirror of everyday life. The American economy of 2026 is no longer built just on factories. It's built on software, on data, and on automation. Value is being created in entirely new ways. A factory producing cars shows up very clearly in GDP calculations, but a digital platform that improves productivity for millions of workers, its impact is massive, yet much harder to quantify. This is one of the great challenges of modern economics. Our economy is evolving faster than the tools we use to measure it. As a result, growth often looks quieter than it really is. Think back to the early 2020s. That period distorted everything. We had massive government stimulus, rapid reopenings, and sudden, unpredictable surges in demand. The economy was pushed to its absolute extremes. By 2026, America is finally moving out of that turbulence, but the scars remain. Households are more cautious with their money. Businesses are more careful about their investments. The GDP growth we're seeing reflects this healing process. It's not fast, it's not dramatic, but it is steady. This isn't a sign of weakness, it's a sign of adjustment, and adjustment always takes time. Consumer spending still drives the vast majority of the economy. Americans are still buying things, but they're buying them differently. They're comparing prices online, delaying big-ticket purchases, and choosing value over luxury. People are renting instead of owning, subscribing to services instead of buying products outright, and prioritizing experiences over collecting material things. This isn't a collapse in consumption. It's a fundamental restructuring of it, and this new strategic consumer doesn't create explosive GDP figures. They create controlled, stable GDP, and that is exactly what 2026 looks like. Now let's look at the labor market. It tells another part of this complicated story. The unemployment rate is low, jobs are available, and yet stress levels are incredibly high. People are working, but they're also worrying. They're worried about rent, about healthcare costs, about debt. Many Americans are holding down second jobs, running side hustles, and piecing together an income through gig work. There is very little rest. From a pure GDP perspective, the employment numbers look strong, but from a human perspective, life feels heavy. This tension between strong data and personal anxiety is a defining feature of 2026. Productivity, which is the output per hour of work, is stable, but it's not soaring. This puts a cap on how fast the economy can grow. People are working incredibly hard, but there's a limit to what they can produce. This isn't laziness, it's exhaustion, and exhaustion simply doesn't scale. Business investment is also changing. Companies aren't just building more buildings or factories, they're building systems. They're investing heavily in artificial intelligence, in automation, in cloud infrastructure, and in data analytics. These investments are incredibly powerful, but they take time to show up in the economic data. When a new factory opens, GDP jumps almost immediately, but when a company installs new software that quietly boosts efficiency, that value grows slowly and is much harder to see. This hides a lot of the real progress that's being made. At the same time, government spending has stabilized. The emergency era of massive stimulus is over, and budgets are tighter. This naturally reduces short-term growth, but it also reduces risk. Again, we see the theme of stability over speed. International trade remains complicated. America imports a lot while our exports are more selective. This creates an uneven balance that can weigh on the final GDP number. But on the bright side, supply chains are becoming stronger and more resilient. The system is learning. Demographics are also reshaping everything. America is an aging country. Older populations spend their money differently than younger ones. They tend to save more, they buy fewer big items like cars and houses, and they focus more of their spending on services, especially healthcare. Younger generations also spend differently. Their consumption is more digital, more flexible, and more experience-based. All of this is changing the very structure of our GDP. Growth is happening, but it's not happening where it used to or how it used to. The hidden engine driving all of this change is technology. AI, automation, clean energy, biotech, and advanced manufacturing are creating enormous value, but they scale quietly. Our traditional GDP metrics consistently undercount their true impact. A single algorithm can replace thousands of tedious tasks that provides a massive boost to efficiency, but it doesn't always increase the sheer volume of output. So growth looks modest even when the economic transformation is massive. This is the great paradox of the modern economy. Confidence is another critical factor. After years of instability, the pandemic, inflation, geopolitical shocks, people are cautious. They spend carefully. That caution slows down growth, but it also prevents a collapse. It acts as a protective buffer for the entire system. Interest rates are more stable now, and inflation has cooled, making borrowing more predictable. This supports steady growth, but it doesn't create the kind of frenzy we've seen in the past. It's calm over chaos. The economic picture is also very uneven across the country. Some states are booming, tech hubs are growing, and logistics corridors are expanding, but many former industrial zones are lagging behind. The national GDP number hides these stark regional differences. That's why some Americans feel the growth, while others only feel the pressure. This explains the disconnect between the economic data and the public mood. The numbers might be going up, but the stress remains. GDP measures output, it doesn't measure peace of mind, and that matters more than ever. The economy of 2026 is not going backward, it's not standing still, it is actively reshaping itself. It's becoming more digital, more automated, and more service driven. This transition is uncomfortable. It creates winners and losers. It creates both incredible opportunity and deep anxiety. And our GDP numbers reflect this tension. Not fast growth, not a collapse, just transformation. The real question isn't how fast we're growing, it's what we are growing into. Are we building an economy of resilience or one of fragility? An economy of innovation or one of deepening inequality? The data alone can't answer that, but it gives us clues, and all the clues point toward profound change. In 2026, America is not in decline, it is in transition, and transition is always noisy. The growth is there, you just have to know where to look. It's quieter, it's more complex, and that is the real truth behind the numbers. It's not a story of weakness or failure, it's the story of a nation redefining its economy, a workforce adapting under immense pressure, and a system learning the value of restraint. This is not the age of easy money, this is the age of careful decisions, and careful economies are the ones that last. The real meaning of 2026's GDP is simple. America is changing, and the numbers are just trying to keep up. Thanks for watching. If you found this breakdown helpful, be sure to like this video and subscribe for more insights into our changing world.